So we're live. So on Fridays we talk with macro traders. This is a all about macro. So basically anything that covers all the markets. As a futures trader, I trade everything under the sun basically, but at the same time I don't trade individual stocks much, but if there is an idea or something, obviously I will put those trades on. So I think the biggest idea of a macro trader is that we trade everything. I always like it was a book you told me about, Kashop, actually. I can't remember the name of it, but it's Jim Leitner's in it. He's talking about the earthquakes in Turkey and buying all these window companies. Do you remember that?
Must have been a long time ago.
It was a long time
But
ago.
I get the point. Yeah.
Yeah. It was some book that you told me about a long time ago. It was like a Market Wizards book, but it wasn't Market Wizards. And so basically, he goes in and he's trading these window companies because of an earthquake in Turkey. And it just kind of shows like, we trade everything and we look at everything under the sun. And so covering that, oh, Kevin's in too. Awesome. So covering that, just jumping into a couple things right now. If we look over the 1 day performance is kind of interesting with platinum up 3%. Wheat's just behind it, up just over 2.5%. Coffee behind that, up 2%. Copper behind that, up almost 2%. It was up almost 3% at one point today. Came back a little bit. Silver up 1.5%. So, and one of you guys got a little bit of feedback on your mic. You might want to turn your mic down a little bit. But yeah, but when we're looking at all of these things, we're seeing kind of a pattern here emerging, especially if we look over the performance in a 1 month time frame. A 1 month time frame, we're looking at crude oil, we're looking at heating oil, soybean oil, all leading the way. Soybean oil, we got a buy signal on that the other day. It's been trending nicely. Could be just news really driving that at the moment, but we'll see. A trend might be emerging. It is incredibly undervalued at the moment, like most of the grain complex. So, Kevin, how long do we got you?
I have about maybe 20 minutes. Is the mic okay?
Yeah, sounds good now. Yeah. So, because we only got you for 20 minutes, Kevin, what are you seeing in the macro markets today? Stocks, sectors, futures. We could talk about grains even, because that's kind of interesting. So whatever you want to talk about.
Yeah, let's talk about the equity sector, equity markets here real quick. So we continue to try to power higher, especially after that jobs report that we had today. Now, what I will say is that job report was fairly mixed. It wasn't all Goldilocks scenario. The jobs that we added, 201,000 or what have you. I can get that number up. But if you kind of look at the previous revisions that we've seen over the last 2 months, we've actually revised lower around 110,000 jobs. So you're looking at 60,000 job revisions, give or take. Past 2 months. And if that continues to accelerate, I think what the Fed is going to have to take into account, and us that really focus on the macro, is the headline numbers that we get immediately are just not as rosy. And in fact, we've known that for the last 8 months, 9 months, probably even more, but the revisions are getting a little bit more aggressive over the last couple of months. So we kind of look at that revision to the downside that we had for last month. I had the numbers up here. Give me 1 second. I'll get you that data point. We had the revisions for last month here. Okay, so like private payroll adjustments, 36,000 jobs back to the downside here for last month's print. Significant. Non-farm payroll adjustments, 54,000. Government payroll adjustments, 18,000. These are all to the downside. If you kind of aggregate that up, 108,000 jobs on the revision side. So I think we are kind of already seeing maybe the labor market having a little bit of churn, and you can see that with the participation rate, small uptick of 0.1%, but that is meaningful because that thing has not moved for the most part at all. And so if we can continue to see that minor uptick, I think that's going to be a key area for the Fed. And then the unemployment rate hitting 4.1%. Now, I've been under the impression I think we would hit 4.2% by September. I think if that is going to be the case, 4.2, 4.3, I think the Fed would say, okay, it's time for us to cut, because we have this huge divergence right now when you're looking at the establishment data and then the household data. And the household data is saying, hey, we're pressured. The establishment data is saying, yeah, we're making jobs, but they're all part-time jobs. So that's kind of where I'm thinking. And then if you kind of looked at and juxtapose that to, let's say, the equity markets, are we going to be seeing cuts in September? Maybe. It's 70% chance, 75% chance, give or take. depending on how you calculate the probability right now for a September cut. I think that's the strongest probability that we've had that coincides with the data that we have seen coming in, right? Soft data and then also hard data. So, be mindful of that. I don't think they should cut in this year at all, but I think that's probably the route that they're going to go. You can also see that translated into the commodity market, and we'll kind of like balance this out, right? You're seeing that in the industrial metals. I had somebody really good follow on my Twitter asking me what's going on with copper. Well, this is what's going on with copper. Over the last couple of trading sessions, the market's really trying to price in from the industrial metals that we might be at an inflection point when it comes to Fed rate cuts here in the United States. And
Kevin, sorry to interrupt, but before we get on to the commodities, so we're talking about the payroll numbers and the unemployment rate ticking up. So what do you see when the revisions come in? Do you see the unemployment rate going higher, or do you see it getting revised lower? What does it look like to you? Because you're really on top of the data.
As far as the revisions for the unemployment rate? Yeah, so they did not revise the unemployment rate for last month's print, if I'm not mistaken. I think that stayed at 4%. This month's move to the upside of 4.1% does coincide with those downward revisions that we kind of talked about earlier, right? When it comes to non-farm payroll, when it comes to the non-farm private payrolls and things of that nature. So what does that kind of mean moving forward? That means that we could have these backward revisions or these upside revisions next month, right? If we can continue this trend. And once again, I would not be surprised if we see 4.2% next month, especially if you look at I don't have the chart, but if you look at a correlation between continuing claims and the director and the trajectory that it's going, that should also then pull up the unemployment rate. So once again, I'm not knocking these jobs that were that number that came out today. We know that the headline numbers have been just smashing analyst expectations for the most part the whole year. I think we only had one print that actually came in below the street's expectations throughout the whole year, right? So we've been adding a fair amount of jobs, but just know that that's preliminary data, and these revisions, even the government payroll revisions, which is surprising to me, right? You have a government number that's being issued by the government, and they're even revising their own payroll numbers to that downside by 18,000 jobs. I feel like that's fairly remarkable to me in the near term. So that's kind of what I'm looking at. Like, am I saying the labor market's like crashing? No, by any stretch of the imaginations, but you are seeing cracks. And if we're seeing cracks now, could that open up the dam for later? Because the labor market, Kashyap, as you know, it takes a lot to be able to try to reverse those trends. So that's kind of where I'm at when it comes to this data point today. I thought that we would see 150,000 jobs being added non-farm. Definitely, non-farm payrolls came in at 106,000, right? But if you average out that revision to the downside, and we do see that, let's say 60,000 revision or even 50,000 revision to the downside, I think that adds up to the number that I'm kind of looking for this print, and that would kind of correlate with models that you have with the continuing claims data.
No, Kevin's always on the data, and that's kind of one thing that's awesome about bringing Kevin on. Is like I always like kind of want to go through things with Kevin that I'm always thinking about the market, because Kevin's like so on point with the data 90% of the time that I'm just like you can almost like talk to him like you're talking to Google sometimes.
Yeah.
with more accurate data.
Right. And then kind of going back to like the you can see it in the industrial metals, and silver too. We talk about that industrial and then precious metal applications. So we've seen those catch a bid here for a little bit. Everybody kind of talks about gold, and like gold's the nice little shiny thing that's in the room always. But if you kind of look at it, gold is actually underperforming pretty much all of those other metals that are out there at this point. So how long is that going to last? I don't know. Honestly, I mean, we have inflationary data coming out next week, Thursday. Like that might be something that, you hear stagflation kind of coming into the picture there. Like, I don't think we can call that until, first quarter next year. So mind you that, but right, the market's all about the mosaic and it's all about the narrative. And so we had the rising prices when it comes to energy. We had some anecdotal data that came out from the ISM manufacturing as well as the services PMI around freight cost, around fuel costs, which fuel costs theoretically has kind of come down in a sense, especially if you're looking at diesel on the retail side, but they continue to cite that. So can we see an upside surprise when it comes to CPI this week or next week? Yeah, I mean that could be the case. I don't want to put the estimate out there right now because we'll probably see those being revised on Tuesday. But if you have a situation where the headline CPI still comes in sticky or comes in hot because of those very volatile products, then
Yeah, I wouldn't be surprised because I track freight futures, the container ship forward curves and all that. And what we have seen is that they are all moving higher, which is very, very unusual because shipping rates crashed sometime around beginning of 2022 when the Fed hiked. And they have been pretty much moving down since. But now with the Red Sea attacks, you are seeing container rates go up again. So that's possibly a very bullish catalyst for inflation in the sense that the stagflation narrative could come back even if you have a couple of lower CPI prints.
Yeah, and I actually shared it. Lizanne Saunders had a really good post here. So if you're kind of looking at the shipping routes, the main ones that are tracked, I think there's only 2 of them that actually have not caught a bid. And every other one, as far as the container rates and freight rates itself, have gone up pretty handedly here. So I'll have to find that post, but it was actually pretty remarkable to kind of see that. So it's being outlined as a factor. Once again, I don't think inflation is going to spike to, I don't even think inflation is going to hit 4% again this year, right? But I think that we still have, sticky inflation, especially on the services front. If we continue to kind of map out the average hourly earnings that we are seeing right now, I think it does become a little bit difficult. But I think the labor market now takes precedent over inflationary data because that's the fear. When you have these labor market type of, we're not in a shock, we're not in a shock, but when you have dramatic drops or these kind of like these offshoots of labor data starting to creep, right, in a negative fashion, all it takes is to have that one shock or that one shocking print, and that kicks off a cycle. And that kicks off not only just a cycle just when it comes to the data, but the mentality that you have from executives across the world, right? Where they're going to say, okay, like we are starting to see some cracking here. We will adjust wages for that. But then we also have to think about the impact when it comes to consumer spend and even industrial spending. Going back to copper, though, there's some green shoots that we have seen this week from PMI data from the Eurozone, right? Now, they're, for the most part, all still in contractionary territory, but they seem to have at least bottomed here in the near term. And so I think there's a little bit of optimism that that's going to be able to carry over. And maybe we do see a situation or a scenario where these other countries that have kind of experienced these headwinds from an economic headwind standpoint last half of the year, first part of this year, maybe they're the ones, the first ones to really come out of it. And so we have that. We have the dollar. I'm going to send you this dollar chart here because I think that's like super important. We continue to talk about this like this asymmetric triangle that's kind of taking place with the dollar, right? Making lower highs, but also making higher lows. And it's really coming up to an apex when you're looking at the weekly chart. And we talk about it literally every single week. And every single way I'm like, we're getting closer to the apex. And like, if you look at that upper channel line, it's like to the T it hits the upside. And then when you hit that lower channel line, to the T, it hits that. And if you look at the weekly chart that's setting up for this week, if we close now, I checked this morning when I was focusing on the UK data, but if we do close the way that we do right now, or the way that we are right now, and that could change, but if we do, I mean, it's a bearish engulfing candle of like the last 2 weeks, if I'm not mistaken. So that's one thing. Two, that should also then put a little bit of positive pressure when it comes to commodities synthetically. I mean, maybe that comes back into the picture here. But now we're kind of seeing that downward move to the downside when it comes to the dollar. So very tight range, but we got another couple of weeks until I believe that we see a breakup or a breakdown. I firmly kind of believe that we will see a breakdown in the dollar. And I believe that the Fed rate cuts are not going to be an all clear signal at all for this market. I think they're going to be cutting because of their concerns when it comes to the labor data for the remainder of the year. Yeah, and it puts them in the rock and a hard place for prices for commodities. Like if any of this move in crude is because of a weaker dollar this week, and that actual correlation comes back into effect, I don't want to use bad language, but like the Fed they're going to be in a rock and a hard place here because these commodity markets outside of X grains, which is something completely different that's happening right now, I believe have tightened up to a point where they've been very dynamic when it comes to pricing. If that is going to be the case, once again, you kind of have that stagflationary thought come back into your mind, where you're cutting because of weakness, dollar weakens because of that. But if you have strength in some of those dollar denominated commodities, X grains, like we're seeing copper and silver, then yeah, it'd be pretty tough. It's gonna be pretty tough market. It's pretty tough economy. Maybe not a tough market, but a tough economy.
No, I agree. I mean, if you look at the dollar, and I'll bring that chart back up too. And it's something that's always important is one is identifying the dollar's trends and identifying when it's range bound, identifying when it's breaking down. It is the most important piece of our landscape most of the time. Yes, there's times where it gets a little bit out of whack with things. Sure, gold and the dollar have gone up at times. Sure, oil and the dollar have gone up at times. But those correlations usually come back into play at some point. And just looking at it right here, to me, this is just screaming a big move is coming. Once again, you seeing something when the bands are squeezing, when the volatility is moving down, that most of the time that's not telling you a direction, but it is telling you that a big move is coming and you should follow that breakdown or breakout. If it breaks out to the upside, you're going to see pressure on all types of areas. If you're going to see it break to the downside, you're going to see commodities possibly move up, moving us into kind of more of a stagflationary thesis, for myself at least. And when we're looking at stagflation, my dot plot continues to be right in the middle of reflation and stagflation. Even though the reflation trade has gotten a little long in the tooth, like it's still hanging out there based on the fundamental data. So we're looking at that in two different ways of going, okay, well, there is a possibility that these inflationary assets start to move higher, even with equities maybe being the underperformer at the time. And it's kind of what Kevin and I were talking about the other week is like, if you really want to take advantage of that trade, let's say energy, I'm not even saying what to pick, but let's say you want the energy trade. You're going to want to be in the commodities at that point. You're going to want to buy oil if you want to be in an energy trade. You're going to want to buy gasoline. You're going to want to buy heating oil, so once again, looking at the actual products is a lot better than just looking at like the equities all the time. Not saying you can't make money in the equities. There's plenty of money to be made in all of these areas. Just saying this market, this environment is telling me specifically that you would want to be in the commodities to make money if these things start to move and break these major levels.
Look at the XLE today.
Yes.
XLE is down, 1.2%, 1.3%. Crude's up 0.5%. Heating oil is up, 0.2% today. Gasoline's up 0.65%. You got the XLE down, and it's not only just the major names. I mean, even if you look at the refiners, so like going into this weekend, we should actually see refiners catching a bid, right? Because we're going to have potentially a disruption when it comes to trade between Mexico and the United States. So there should be some, maybe a catch-up trade there, or maybe they could catch a premium because of that weather bit, and they're not. And so this is actually like the perfect example of divergence between the commodity and then just going into XLE. It's not a really good proxy. And then it's the same thing with UNG and natural gas. Natural gas has been getting hammered, right? But if you actually look at some natural gas plays, this is an LNG play. I look at LNG, Cheniere Energy. If you even look at some of the other ones, they're doing relatively well compared to what natural gas is doing. So you can have these disconnects in equities and valuation and commodities, and you just got to be mindful of that. We have earnings season starting next week too. Friday we kick off bank earnings, and then we're going to start getting into the nitty-gritty. So you better start looking at those fundamentals of a lot of these companies. If you've been riding those waves because of commodity moves, be very cautious about that. I mean, if you're looking at midstream businesses, you're looking at the refining business right now, those margins are going to be very tough there this quarter. There's no sugarcoating that. No matter if crude oil is moving up 15% over the last 2 weeks, 3 weeks, it's going to be a tough quarter for them. How's the market going to respond when they say, hey, yeah, our year-over-year comps suck? And then the outlook when it comes to the consumer and gasoline demand has been weaker than what we have expected this year. Our outlook might be a little bit more murkier. And if we stay rates at these particular levels right now, We expect, tighter margins. Now they could spice it up by providing buybacks, right? They could spice it up by doing dividends. I mean, we've seen that being the ace in the hole for last quarter for a lot of these companies, just even outside of commodities, where they can, pepper up some of their earnings announcements that are a little bit weak by some of these, financial engineering type of strategies. But you might want to look at some of these fundamentals for a lot of these refiners right now. Midstream is going to have a little bit of a tough time when it comes to earnings power this quarter.
Oh, and when you were off last week, man, this is a first for me. The only time you're ever going to see this, it's right behind my logo, of course, where you see the uptick. But LNG actually started to make a nice move. We talked about it last week. Basically, we have this major squeeze pattern that happened. Then we break out to the upside. It's still moving nicely. So, that's one that we've been talking about here. Kind of interesting to see, it's one of the producers, but also while natural gas is falling, like Kevin said, it's the opposite. We're seeing energy going one direction and then oil going another direction. We're seeing the opposite directions in natural gas. So it's quite interesting that both of those are happening. So it's going to be an interesting summer. And once again, something always to keep in mind, summer is frustrating for every single trader on earth. You're going to see a lot of false breakouts. You're going to see a lot of pain. You're going to see a lot of choppiness. Just be ready for that. Volume is going to be pretty dry. So as you're ready for that, but there are going to be opportunities that are going to come your way. And this looks like one of them.
So here's the funny thing, like it's summer and we are supposed to get a lot of chop, but I am getting a lot of buy alerts getting triggered. Like on a daily basis, one or the other buy alert is getting triggered, which is insane because I would not expect that in this environment, but it's happening.
So here there's two things about it. It's a reason why I always trade through the summers. And I just talked about this the other day, which is when you're in these summer months and you have this like choppiness and you're expecting it, sometimes you'll get these major trends that'll happen. I mean, the Bitcoin trade started last year, of course, around that time. And then if you look at the just being set up for all the equity moves, that was also another thing that happened in 2020. So it's kind of like you want to continue to take your signals, take the buys, trade the right way. One, it's discipline. You need to have discipline as a trader. Discipline above all else is the most important thing. Two is you want to be set up for that next move. And three is there's a possibility you miss a major move. So some people get out of the market, sit on their hands. I always suggest like keep taking your signals. If you're not trading too large, it's not going to kill you. It shouldn't ever kill you. It's just chop. Most of the time what happens in the summer to me is I get a bunch of buy signals and they go up and then they come right back and we're either flat or down 1% or up slightly. It just doesn't matter.
Yeah, I would say for July, it's actually I believe it's actually the strongest month that we've seen when it comes to tech. Yep. So if you kind of look at that breakdown or the market cap weighted S&P 500, right, or even if you're looking at NASDAQ, right, like if that is going to be the case and they do catch a bid, it should for the most part maybe rising tides lift all boats, right? And so I think that's something to kind of be known. And then also when you have low volume, you could have choppy markets and low volume, or you can have really strong trending markets and low volume, because it really doesn't take much size to move a market in those environments. And I think that's kind of what we've been seeing for the last month and a half or so. Going into earnings season though, too, what's going to be the focus? It's NVIDIA, it's going to be AI, right? And that can carry these markets until somebody says, look, we're going to just pause on spending, or we're just going to like cut back on our spending. We got a little bit of aggressive, cost of compute's gone, ridiculous, which it has. Until one person says that, I think that's kind of where you continue to see these power moves. And then ex-CPI next week, I mean, you have Powell speaking and testifying. I believe he's testifying to Congress on Tuesday or Wednesday. But actually, I think it's both, right? I think it's the House one day and then the Senate next, maybe. He's testifying to somebody next week. You have PPI data on Friday, very volatile. You got CPI. Yeah, I think that would be like your volatile day. But I mean, outside of that, you don't really have that much to be able to give you as far as headwinds in this market. So, I would always say just kind of still be cautious. But I think the next 2 weeks are still for the most part, remain fairly bullish in the equity space right now. I'm looking at crude, man. Like, look, full disclosure, I'm surprised that it's trading at 84.40 right now. Like, I would have loved to see, and we can't pick our markets. You can't pick whatever happens, right? I would have loved to see the 82.50 rejection off that weekly, come back, test, say 78.5, 79, and then power higher. Weaker volume day by day is with price advances. Maybe we're getting a little bit long in the tooth there, but if that's not going to be the case, and we have EIA and API data that does align with kind of this thing that we have seen over the last couple of that we've been talking about, where you start getting strong fundamental EIA data coming out, boom, that could be your very strong catalyst. And if that's going to be the case with the readjustment and the reclaiming this upward megaphone pattern, if that's going to be the case that we have right now, you could say 90, and I hate saying that, but if $90 a barrel oil is destined for us in the next month or 2 months, I think that would be crazy. And I don't know what that's going to do with the equity market. Is at some point they're going to have to be able to focus on that, and they're not right now. I think that's, like I said, I'm surprised that we're trading at 84.40. I mean, Jason, what I've been saying for ranges all year, right? 80, 85. I mean, we're literally going and swinging down channel, upward channel range in a matter of 2 weeks. That's remarkable to me. And with that kind of squeeze pattern that you got on that chart, you do see a breakout. It could be a remarkable one, at least until we peak out like mid-September, which is what we saw this time last year.
Yeah, I mean, go ahead.
Yeah,
go ahead, Kishore.
I have a slightly different take on that. I think the move that we got all the way down to $72, that was very misguided, and that was probably a lot of long liquidation that just went on. And the bounce that you saw straight from that is probably an overshoot in the other direction. And I think we will get back and start basing in the 80, 85 range and not get that move to 90, even though the move to 90 would be great to see, but I don't think that's in the cards. I just think that it's too much of positioning getting skewed one way and then the other. And that is also kind of the way it's been with every market, where when you have a sell-off, it just goes for days and days and days with no rally. And then when you have a rally, it just goes for days and days and days without even a single red candle. And I think that's pretty much what we are seeing in oil, but maybe I'm wrong. We'll see.
No, Kasha, I'm right there with you. I like 85. You can make a fundamental thesis why 85 could be your top level, especially when you're looking at 3-2-1 crack spreads, right? I'm right there. I'm not saying like we will hit 90 or anything like that. I think that would be an overshoot. The only thing that I say maybe that happens is because who's talking about crude right now? No one. No one's talking about it yet. No one started talking about crude the last run up that we had in March. No one started talking about crude until it hit 80, 81 maybe. And everybody's like, oh man, like we got it after it hit $10 up off its lows. Everybody's like, oh, okay, like let's do this. Now it's the time to get in. We had this blow off toppy scenario that kind of took place, kind of like you're talking about. Like we oversold way too much and we overbought way too much. My thing right now is like no one's talking about it to the upside. We're sitting at 84. Like, what is it going to take for? I won't call them dumb. What is it going to take for those late cycle traders that then come in and say, oil is going to hit $100. Oil is going to hit 120 until you get the Goldman Sachs that are like 150 oil this year. Like it definitely can happen. You know what I'm talking about? You guys know what I'm talking about. We're not there.
The second it breaks out.
Yeah.
And here's the other thing to always keep in mind with oil, who's mainly creating these big moves in oil at a certain point. So there's trend guys who are buying those breakouts, 100-day highs, 150, 200-day highs. When you see those levels start getting broken, that's when you're going to start to see people really following this trade. And right now, what I love about this type of a pattern, and this is my favorite pattern. Like, this is my favorite thing. I have talked about it for years. It's the same thing I do again and again and again, which is you see a tight squeeze pattern. when you see a tight squeeze pattern and a breakout to the upside, that really tells you a lot about the market. So basically, that tells you that volatility is squeezing. Everybody's indecisive. Nobody's really making a move one way or another. Everybody, like we're talking about, nobody's talking about it. Nobody's pushing the trade one way or another. That's the best scenario for something to happen. So that's the best scenario for a breakout to really continue. So if we really do get to that $90 level, this could be an absolute ripper right to the upside, back to those levels of 100, 120. However, once again, Kevin and I are the same with like, I don't want to call out price targets. My main point is you want to follow this breakout. I think this breakout could be significant. You get up and over, basically we got a false breakdown signal back there, which was phenomenal. So the false breakdown happened. I think that was around 75. We started to trend up higher quickly. And now if we break this old high over here, let me find the level so I can say it for everybody. We break that level of 87.50. And then we break that next level above $90, $91. We start to sustain above those levels. There's no reason that this can't make it to 100 and continue higher. But basically, to me, I'm saying it's well worth it to just put on the trade on that breakout and just sit on your hands.
Yeah, like I said, nervous. Nervous. Break 85. I mean, the data that we had this week was
if you promising. Are a breakout trader, I should say.
Yeah, right. Yeah, I mean, the data we had this week was somewhat promising, right? But there's certain pockets that were still weak. So, I like to move real quick because I do have to hop off here. Heating oil, we talk about this all the time. Diesel, right? It's touching that 200-week moving average. It is going to be an area of resistance. This is the make or break for it. MACD's looking like it wants to cross. I mean, that thing's still basing. If you guys use MACD on weeklies, I love MACDs on weeklies. Still basing. RSI might have already kind of broken out to the upside, but like we tested the 200-week. We're literally trading on it right now. 200-week moving average, 2.624. Heating oil is trading at 2.6375. You don't like to see that upper wick where we saw some sellers getting in, but if it can break, and if it can break handedly next week, there's a pretty decent gap range. I mean, your first area is going to be your 50-week moving average, $2.77. Let's say $2.78, and then you have another area of resistance at $2.96. If that were to happen, we will have an inflation problem. That's not a call. That will be a problem. We're already 15%, 16%, actually probably even more than that right now off the lows. And you're talking about another, 15% move to the upside, give or take 15% move to the upside in aggregate. That will show up at the pump. That would be an interesting scenario for a Fed meeting going into September. So yeah, that's the chart. Now, like long term, you can kind of say, hey, is this a bull flag? Could be, right? Bull flag basing out. You have equal distant or leveled out lows there. That gives you the kind of that range. Maybe we break to the upside. If not, we see failure. Maybe you see a drop to the downside. Who knows? But the 200-week is always a key area for me when I'm looking at these markets. And if that thing can actually break, it would be a substantial one. And actually, gasoline too, hard on the inventory side, but gasoline bounced off that 200-week. If we see a similar type of move, gasoline's trading at $2.6175 right now. That moves up to $2.85. That's meaningful. That is a meaningful move. So I just say that all as some technical and fundamental, and I'll kick it back. The Fed's in a rock and a hard place. That's all I'm trying to say. That's a bad. I mean, like, let's look at the transitions that we've made today, right? We talked about the labor market numbers looking good, softness in some other areas there. You have inflationary data looking decent, but we kind of have a print on next week, and we have some inflationary trends that can actually impact, the growth cycle there. And then you also have metals that are pricing in a rate cut in September. All three of those things can't be true. And if they are, there's only 2 times in our history in the United States that we've actually had to deal with that. And they're not good. So, not trying to be a doomer. I'm just trying to be a realist here. Something has to break.
Yeah.
With that, guys.
All right, Kevin. Thanks for coming on.
Appreciate you.
Another thing that's interesting about what Kevin said as he gets off here. Thanks, Kevin. Everybody give Kevin a follow as well at KG Bull and Bear. But just looking at this chart, if we're looking at and I think this is also always important, is when you're looking at the 200-day moving average and a 200-week moving average, they're both linking up at the same spot here. And so most of the time, you're going to see a lot of resistance at that zone, or if we break right above it, that could be pretty significant, leading to a significant move to the upside pretty quickly. So once again, these are all levels to keep paying attention to. Heating oil isn't going to work the exact same way as everything else when it comes to moving averages, because guess what? There's not a ton of news on it. If you see something like the NASDAQ hitting a 200-day moving average or breaking it, that's nearly news nowadays. Like technical analysis was never news back in the day, but you'll see it on every single blog everywhere that the NASDAQ broke the 200-day moving average, and usually that makes it go back up the other direction. Commodities, when they tend to break moving averages, most of the time they go right above it. I mean, go back to that 200-day back in 2020. When you get the 200-day back in 2020, which is the blue line on this, that's 40-week or 200 days, it just moved right above it, just trending higher very quickly. And then if you go forward, you can see times of it breaking above it, below it pretty quickly. So these don't work the exact same way because equities are very mean reverting and commodities are very trendy. So I'd be really open to this moving to the upside. So going through some things, Kashop, what are you seeing in the markets right now? What are you, Kashop has a new newsletter. He's been putting out some great research. What are you really looking at right now on your paper? And you guys could see his Twitter sign on there. So if you guys want to follow Kashop and get his research, it's on there as well.
So right now, I'm more focused on gold because it's really working. And the other aspect is it's unbelievable how cheap some gold miners are. It's just unbelievable. Like here you have a move in gold so everyone wrote off gold last month just because the PBOC, the People's Bank of China, announced that they stopped buying gold. Everyone wrote off gold and said, okay, this is it, it's done. And then you had that, you had gold, what was it? I think it was a triangle. So it made that pattern, it moved right back up, and gold is doing great, but the miners not so much. But that doesn't make any sense because these companies are now gushing cash. They are not wasting it on needless acquisitions. At least most of the good ones are not wasting it on needless acquisitions. So the market should actually be re-rating these stocks higher, but it's just that once beaten, twice shy. So every single rally in gold, you had these miners take off, investors get hopeful, and then company managements do something stupid. And then the stocks go right back down, and then the cycle repeats. But maybe this time it's a little different because after all these waves of consolidation, the big companies are really not looking to acquire any more assets. The ones that are looking to acquire assets, those are the stocks you wouldn't want to own anyway. So you're not going to get this constant rug pull where you buy a good company and then they go acquire a crappy asset because they have a good treasury. So that's not happening. And at the same time, the junior market, which is the explorers and the developers, which are the pre-revenue companies, they have been capital starved for the better part of 2022 and 2023. So every time they have raised financing, they have done it at a lower and lower valuation, and they have diluted equity holders. But now they are sitting on assets that should be valued at 2,400 gold, 2,500 gold, and they are really not. And if this is the start of a secular bull market in gold, and we haven't had this in the last 12 years. So gold topped out in 2011. It had a slight up year in 2012, and then that's it. Like maybe after 2018 you can say it started picking up again, but then you got the COVID crash, and then you had that small move all the way to August 2020, and then that's it. Gold hasn't really had a move or a significant move in more than a decade. So if you do get that kind of move, then you're going to see all these assets, all these development stage assets, which is just ounces in the ground. So instead of being valued at maybe $10 an ounce, they're going to be valued at $12 an ounce or $20 an ounce. And that re-rate is going to be significant. And it's the same thing we have seen in the crypto market. So you have 13,000, 15,000 coins, whatever, and they had all been left for dead after the FTX crash. Then you have this little bit of liquidity coming back, and suddenly all of them re-rate higher. And it's just a function of liquidity. So I'm really seeing a lot of these pockets of value in the gold space, which is what I'm mainly focusing on. And the other thing I'm looking at is oil and gas. So especially the service providers and very, very select EMPs, which for some reason the market is just not interested in. And these were the companies which were both value and growth in the last cycle. These are the companies which have good land positions. And when it comes to the services stocks, these are companies which again have really good PE ratios, are probably selling below replacement value, but right now the market just doesn't care. And we were talking earlier about how the oil market is different from the equities market. So here's a story on that. So last December, the oil services stocks really took off and went on an amazing run all the way until March. And oil was actually down to flat during that period. And you just had this divergence where it was you shouldn't have owned oil if you're an oil bull, but you should have earned all these service stocks. And now you have a period where oil is going higher and all these stocks are going down. So once again, you have this divergence, and it's just something that. So I used to only trade the equities, and then I remember after 2020, especially, I remember talking to you, and you kept telling me you have to trade the futures, you have to trade the futures, and since then when I started monitoring both of these, I can really see these divergences happen. So
Yeah.
it's also fun, like you get to switch between the commodity itself and the equities, and you can just go back and forth, and whatever is trending you make your money on that. And I think right now the oil stocks are not trending, so if you take a value approach you buy that. If you take a trend following approach, then you buy oil itself. So I mean, there's something in the space for everyone, which is again why I like oil so much. So gold and oil. And the third thing I'm focused on is nickel. And that's mainly because no one's talking about it. And nickel is kind of in a supply glut. But here's the thing, like what we saw with copper. So I was talking about copper back in Feb and March when no one was talking about copper. And what I saw was all these LME rules and all these sanctions, that was going to affect copper. And now recently, which is like I think a couple of days back, we got this news that the LME is not going to take Russian nickel into the warehouses. Even if said Russian nickel comes from Finland, they're not going to take it, which is pretty nuts. So now you have Russia versus the rest of the world, and you have the countries which are friendly to both Russia and the West. Now they are going to be put in a spot. And so the thing with the commodity is it shouldn't matter if your commodity is made in Brazil or Argentina or Russia or India or US or any part of the world. But once you have these specific sanctions coming in against, I don't want Indonesian metal, I don't want Russian metal, I don't want Russian metal, even if it has been routed through several intermediaries. Now, when you have all these things happen, what do the physical traders do? They say, I don't trust your origin. Show me your origin certificate. And then it goes up the next level on the supply chain. So you're just going to get all these disruptions. And one thing that happens when you have disruptions in the physical commodity flow is you see the prices going up. And I think that's what's going to happen. And it's not a long-term secular bull market in nickel or anything like that. I just think that because of these disruptions, you're going to see that kind of move start again. And it was the same thing that we saw with copper. And now copper is back into a bull trend because it held that support perfectly well, and it's moving higher because so you had that catalyst. And I think we are going to see that same kind of catalyst here. And I'm surprised that we haven't seen that with wheat, but I think you're the better person to talk about that. Like, so what's happening there?
Oh man, that's a huge story. So it's quite interesting because I actually went through this just the other week because we had the trade in wheat. It did make a couple bucks. It wasn't like anything great. It got into profit. Stop loss got into profit because it had that huge jump, and then it came back and had what 10, 12 down days in a row, something like a record for the last 10 years or something. I mean, it was wild. So I had to, obviously, my brain, I have to go, well, why, how many times in history have we seen that type of a move? And Sam Gatlin actually made a chart of this. And so he made a chart of it. He's showing me, all this, all the backdating of it and how many times it's happened. And so I have to then go back and start checking all of the research on it because I'm a crazy person. I wouldn't suggest, I don't even know if this pertains to trading as well as I took it. But so I go back and I start to look at all these breakouts, breakdowns, and when we have these crazy end run periods where it just breaks down over and over again, it seems to happen in June every single time. And that's the thing I kept finding is like, okay, like 2010, I think it was 2016. I can't remember them all off the top of my head right now. I'm going to write a paper on it. But all of these things kept having these major end runs, and I was like, but it also led to shaking out all the sellers, shaking out all the bulls, and then basically there being terrible sentiment for it, and then the price started to move up right afterwards in July. Every single time the breakout happened in July, so basically it would bottom in the end of June. Or beginning of July, and then it would just continue to move higher for the rest of the year. And I found that insane because it happened again and again and again. So then I had to go through, and because I'm even crazier, I have to go through and see what was the weather at that point. And it's very similar, the same type of year, very mild winter. People start planting very early, have this crazy, I mean, we had a crazy heat wave in the United States. This is the other thing that's crazy about this move in wheat. We have this insane heat wave in the United States, which heat basically can make it so your crops just can't grow. Your crops are getting fried, or unless you spend a ton of money to keep up on this. Basically, watering, shade cloth. There's a million things you can do, but like you're talking a ridiculous amount of money to do that on a major scale. So most of the time, it ends up with a lot of lost crops. And so we're seeing that again and again and again, where we're seeing a lot of lost crops. We're seeing a lot of people running into major trouble. We're seeing diseased crops because what heat also does is it opens you up basically by cutting the leaves and so on. Like you can open yourself up to diseases. So a lot of crop disease and so on. And we saw that in all of these years. And so I have 2010, 1983, 1998. It looks exactly the same. If you look at the weather anomalies, like you basically see that across the board, it looks exactly the same. So you have this weather anomaly again and again and again with these crazy heat waves, crazy periods that look exactly the same, that lead to this huge drawdown in wheat in June, and then end up in breaking to the upside. So I keep looking at this and going like, okay, if I was really to sit down and like think about it fundamentally and take the charts completely out of it, which I never do, but let's say I did that, I would go, wheat will be a lot higher at the end of this year. Wheat is, I would assume what we saw, that higher low that just happened, and once again in late June, which happened every single time I went back in history, this pattern in late June, I would say that was a bottom. And I hate calling bottoms. It's not my game, but I would say that that's a bottom. And once again, like what I also do is I always look at history. If I'm a person who uses back tests and I back test history, and history tells me that most of the time that this scenario happens, this is what also happens, and the rate of that being right is nearly 100%. I'm saying the smarter trade here for wheat is more upside to go. And probably all of the grains across the board. Like you got to think, in the United States, we've had to take a huge hit in all of our crops over and over again. I mean, Kevin brought I wonder if I still have this on my list. Kevin brought this great chart the other day of cotton. Let's see if I can find this thing. But he brings this great chart of cotton, and it basically is showing that when you're looking at cotton, that basically all of these years are linking up, as in let me find this thing. Give me 1 second, guys. I gotta find this because this is like spot on, perfect thing to talk about right here. Kashap, so what are you thinking about any of what I just said? Will I find this thing?
I think makes absolute sense. Like if you have a recurring pattern and it just, is something that you're back tested and you have found to be true, you should just take the signal. It's as simple as that. I mean,
Yes.
It doesn't matter why it works. And this is something, again, I think we talked about a few weeks back when we were the last talk that we did, where we talked about the Swiss franc. And you had this massive downtrend, and then you have this start of a primary uptrend. And neither of those move make much sense because the dollar's been pretty much range bound. So there's no need for the franc to move lower. There's no real need for the franc to move higher, but it just happened. And what do you do when you see a situation like that? You just take the trade, and you figure out the fundamentals later.
Yes, because that's when they come into play. Really, is later. The fundamentals never come in, because that's the thing. Is like right now, It's kind of like when people are living in the world and going, "Oh my God, there's no inflation," but I'm living in the real world and there's inflation everywhere. It's the same thing with crops. Is like looking at it and going, "Okay, I can see that." I walk outside and I see a plant that I didn't water enough, and it's literally fried. And then you also talk to farmers and they're talking about their crops getting fried. All of these things are happening, but the price of wheat, the price of corn, the price of soybeans are all coming down at the same time because the fundamentals usually show up later. So next thing you know, and that's what I keep talking about in the letter over and over again, is that we're going to see this move happen. However, the data has to start supporting it. And the way people hedge those crops, they're not like me. They're not taking buy signals and sell signals and so on. They're looking at the data. They're trying to see the data come out, seeing if they need to hedge their crops or not, and so on. But I personally think like that was a bottom. I think that to year end, maybe at least the next couple months, we're going to see a nice rally in most of the grains. And this is what Kevin brought up last week. Earlier this week. So if you guys want to see what Kevin said about it, because he'll articulate this much better than I will, please go back to the commodity report that we released on Wednesday this week. It's on my YouTube channel. You could also see it on Twitter. Most people are on Twitter anyways. But yeah, so if we're looking at the crop conditions here, so this is crop conditions for cotton. And if you look at it and you go to North Carolina and you go, okay, they're at 32%. And if you look at their worst year, which was 1997, so that's the on the left side, you'll see North Carolina. Follow it till it says low year, which is 1997. That says 33%. So it's in its worst period ever. So you're seeing this kind of like across the board. And some of those years that I talked about earlier, you'll see those also here. So I'm just kind of saying that this is really bad. Like if you just look at the change month over month, year over year here on the in the middle, the ones that are red and green, like you're seeing a lot of these crops that are supposed to be good to excellent condition cotton crops are actually getting hit pretty badly. And this is very rare. This doesn't happen much. Like you don't see this to this level. You don't see double digits, especially in Georgia. These things are not things you see. So cotton, wheat, soybeans, corn, like these things are set up to move. However, like we need to watch these major price levels. Just the same thing we did in, oil. You watch that false breakdown signal, and then you're watching those major price levels. And if we look at, wheat, so let me see where wheat's major price level would be for Chicago wheat. Ticker signal ZW on futures. You're seeing that we had that higher low happen. you're seeing that the next major resistance is at the 200-day moving average or the 40-week, which is what I have up there. It's the same thing. It's at 590. So basically, like, I think here, if the safe bet would be wait till you get above 590, then you take a half position. Then if we actually take out, that old high, let's say that old high, which is at, it's right at the 200-week moving average, which is 710. We take that out, we're absolutely moving to 1,000. Like, I would be entirely surprised if we take that out and don't move that in that type of magnitude, just because of the way wheat moves. Now, once again, wheat is incredibly choppy. It is very hard to trade. You have to trade it very similarly to natural gas, small positions, hold them for a long time in a long-term trend system, and that's how you make money in it. However, though, it is set up to make this large move. So is corn. So let's look at corn. Corn also has the same exact setup. It is no different. However, the chart looks terrible. So you just don't buy things where the chart looks terrible. It's definitely in a downtrend. Wait for that to get up above another level too. And this is the hardest thing to do as a trader is go, I have this great thesis. It makes perfect sense. I think this could make a move, but now I'm going to sit on my hands and wait for it. I like to use buy stops. I think that's the easiest way to do it. Use a buy stop. Wait for your whatever systematic way you have to trade, or wait for a major level to break. So for corn, that level is 452. We get above 452. This thing could absolutely move at least to 565 very easily. So once again, these are things to just watch out for, pay attention to, and see where that ends up. But I really like the commodity space right now. I think there's a lot of value, especially in the things we've talked about today, which is the growth-based commodities like oil, heating oil, gasoline, and then copper, the industrial metals. Precious metals to me are the easiest trade it's ever been. I've never seen a precious metals trade scream at my face this much, but like, I can't believe people argue with me all the time about like, oh, silver is long in the tooth. Silver, like, you have no idea. I don't even have any idea how. So I didn't live in the 70s. I don't know how silver is going to trade in this environment, but I can tell you I've traded silver for a long time, at least over what 14 years now. So I've been trading silver for a long time. I've owned actually precious metals for over 20 years. I can tell you we've never seen this type of environment for these things. Yes, we had this major move in precious metals in the 2000s all the way to 2010 or 2011. Sure, we had that big move, but this environment could be even better for silver. Silver should run up back to 50 again, I think. I'd be surprised if it doesn't hit 50 in the next couple of years. I think we should break that level. I think we should even carve out a new range at some point. So I agree with you. Go ahead.
The last bull market in precious metals, you had to go to coin shops, you had to order online, and you had to get your bullion delivered. And this time you go to Costco and you buy it. And they are selling silver, they are selling gold, they are selling everything. And I even saw someone talk about how they are ordering copper coins. And that's insane. That's the kind of thing we haven't seen in forever. So I remember it was like 5 years back, I was on a mine visit and I met a guy who had physical platinum and palladium bars in a vault. And he bought it in the last cycle, just held and held and held, and was like, I'm going to liquidate it. And I think we are going to go back to that kind of environment. So Soros's fund, if you look at the history, I think they went to Russia and they made a deal with the Soviet government where they said they would buy their physical metal from one of those Norilsk mines. They said they would buy it and ship it to a vault in London and just hold it. So you had these funds make these kind of moves. You have to go back decades and you have to read some books to see that. But you can really appreciate the kind of perspective they had. Like, they could see this move coming and they positioned for it. And right now there are these funds which are buying cobalt. That's in the news. And I think it's just a matter of time before they start stockpiling palladium. So, especially with this LME news about them not taking Russian origin metal, I think it's going to become incredibly important for people who really need the commodity to secure their access to the commodity and not keep it with a third party where any minute you're going to see sanctions or other rules just come in and say, sorry, like you thought you had access to this, but you don't have access to this now. So I think custody is going to become important. And I think that's something that's really going to drive prices higher because so far people have been happy to just have a derivative contract and say that, okay, I know that when I do need delivery, I will get it. But once you take that certainty away, stockpiles go up. And I think it's going to go up for all the metals. And I think it probably goes up for the grains as well because it just makes absolute sense. When you have uncertainty, what do? You stockpile. I mean, we saw the extreme version of that with the toilet paper mania in 2020, but it's a natural instinct. Like you just want to stockpile stuff when you're uncertain. And oh, here's something interesting. So Denmark put out a press release. The government put out a press release asking people to stockpile iodine and other essentials for like 3 days. And the UK followed up by saying that, it's a good idea for the citizens to stockpile stuff. So when you have these major Western governments saying stuff like that, the only thing that comes out is people are expecting a shortage and may not be an immediate shortage. The shortage may not even come about, but the moment you hear the word shortage, so I come from India and I have dealt with shortages all my life. So the moment I hear something like that, I'm going to hold. It's just instinct, it's just the prudent thing to do because worst case, what happens? Nothing. And I think Americans have the same instinct, like you stockpile guns, ammo, Campbell soup, and water purification tablets. Like you have the whole, it's standard, right? It's common.
It is
and especially with all these snowstorms. Yeah.
It is common, but it's also interesting that it's like it's a specific sect of people in the United States. It's like it's just a few people, that do things like that. In the United States, basically everybody lives like paycheck to paycheck. They spend as much as they can. They have nothing at the end of the week. They wait for their paycheck to come back. I mean, literally, it's like a living like there's abundance forever, even though there isn't any, which is wild. Like, but that's what people do in the States, which is crazy. But like, yes, there are and you should, when it's a shortage, you should have that mentality. You have the mentality you're talking about. Like, that makes perfect sense. If you look at gold, though, and this is another thing that's interesting. I went to a gold store the other week. I'm at this gold store. I'm having a conversation with this guy, and I go, "Hey, is it getting crazy yet? Are a bunch of people coming in trying to sell, or a bunch of people coming in trying to buy?" He said, "No, there's nothing. He said we have way too much gold, way too much silver, so their premiums for people to sell it to them are so high, so they're only doing it at 85%, 90%. So basically, if you have $1,000 worth of gold, you're only getting $900 or $850. So you're running into this situation over and over again, and I'm like, well, where's the mania? Like, gold's hitting highs. It's at the highest price it's ever been. Why aren't people interested just yet? And what all I'm seeing in that is that gold probably has a lot more upside to go. A ton more, probably, not just a little bit, probably a ton more of upside. So I think, we'll end on that. I think that's a great place for people to just kind of go, let's meditate on that. Maybe buy some more gold, start looking into the miners, start finding Kashop's picks. But man, there's going to be a lot of things to buy coming up here in the future. I really do think gold and silver, you just got to own it. Platinum's starting to make a run. That hasn't happened in a long time. So, I mean, we're probably in the earliest stages of a precious metal bull market still. So I'd be ready for it. A lot of people just aren't, and they're not going to be. Yeah. All right, guys. So thanks for hanging out with us. We have this show every Friday at 11 a.m. Eastern time. I'm also on Mondays for the commodity report at 11 a.m. And I'll be back at 2 p.m. today, 2:15, with a hedge fund manager. So if you guys want to come have some questions for him, please drop on by, and we'll see you soon.